If your FHA mortgage just got flagged for a manual underwrite, it doesn't mean it's dead. In this video, I'm going to walk you through what triggers a manual underwrite, what HUD actually requires without the lender overlays and myths, and how to get these loans approved and closed. Ideally, the borrower's loan application is run through the automated underwriting system and it issues an approve. But that is not always the case. Sometimes it issues a refer, which means the underwriter has to manually refer to the HUD guidelines on credit history, debt to income, assets, and make sure that it meets HUD standards to perform a manual underwrite. In rare instances, the underwriter will still have to perform a manual underwrite even when the system issues an approve. I'll list those specific situations for you down below, but the main culprit is that the borrower has over $1,000 collectively of disputed derogatory debt. In that case, the credit score is not reflecting those disputed derogatory accounts, meaning that our automated underwriting system is basing its decision on an inflated score. Manual underwrites for FHA are absolutely nothing to be scared of. You just have to understand the additional, straightforward guidelines that HUD has in place, and you can get these to the closing table with no delays, with ease. I'm Erin. I've been in the mortgage industry over 20 years, and I work on these file types every single day. HUD really just has 4 requirements to check that are above and beyond the normal FHA guidelines. The first one is on the credit. I know, it's a scary word, but we're gonna use it. When reviewing the borrower's credit, a great place to start is the installment accounts. That's things like car loans, student loans. HUD does not allow any lates whatsoever in the last 12 months on installment. They will, however, allow a total of 2 30-day lates the year prior. Also, the borrower cannot have any newly opened collections or charge-offs on installment accounts in the last 24 months. The next thing you want to check is revolving accounts, and this is things like credit cards. HUD is much more lenient here. They actually allow up to 3 60-day lates in the last 12 months on revolving accounts, but no 90-day lates. You only have to do a 12-month look back on new collections and charge-offs from revolving accounts. So what if the borrower did have a late in the last 12 months on an installment account and you feel there was an extenuating circumstance? Successful extenuating circumstance situations are difficult, but the requirements are it had to be an isolated situation, meaning that when we review their credit report, they had excellent credit before that one blip and they had perfect credit after that blip. If we see late payments sprinkled throughout the credit report, that is not an isolated situation. Other than being isolated, the situation that caused that extenuating circumstance has to be documentable. We cannot just accept a letter of explanation alone. We have to have some documentation backing up the situation. For example, if the borrower had a car payment late within the last year due to a job loss, we would need documentation that they lost their job. The event that caused the derogatory on credit also has to be very close in time to the derogatory credit itself. For example, if the borrower lost their job, we're going to want to see that they had lost their job immediately prior to that derogatory event on credit, not 6 months or more prior. If there's too much time between the two events, then we cannot tie them together. Lenders need a letter of explanation for an extenuating circumstance, which needs 3 parts. What happened, what they did to get caught up or fix it, and most importantly, what is different now, keeping a similar situation from happening again. Keep in mind, the circumstance should never be related to financial irresponsibility or forgetfulness. So that's the credit section. Let's move on. The second requirement is the housing history. If the borrower is paying a mortgage, that means no lates at all in the last 12 months. If they're living rent-free, let's say with a family member, then we just need a rent-free letter signed by the person that they're living with, stating the relationship, how long they've been living there, and that they do not pay any rent. If they are renting somewhere, then we need to see the last 12-month history. The loan officer can add that history as a credit supplement, which works great, or get a verification of rent directly from the landlord, as long as the landlord is not a family member and is not the seller of the property. Or the last option is to collect the last 12 months of rent checks. The third requirement that HUD has for manual underwrites is reserves. This means if they are buying a 1 or 2 unit property, then you just need 1 month's PITI in reserves left over after closing, after they have brought their funds to close. That means just 1 month of principal, interest, taxes, and insurance on their new housing payment needs to remain in their bank after closing. If, however, they're purchasing a 3 or 4 unit property, they're going to need 3 months reserves to meet the HUD guideline. Let's move on to debt to income. Although HUD will allow a DTI up to 56.99 if the loan is not a manual, HUD does cap the debt to income for the borrower on a manual underwrite. They can go up to 31/43 with no compensating factors, up to 37/47 with 1 comp factor, and an absolute max of 40/50 with 2 compensating factors. The comp factors I'm going to list out for you below. One comp factor example would be 3 months reserves, PITI left over after closing. Another would be a minimal increase in their housing payment from what they're currently paying to their new mortgage payment. Another would be residual income, which the underwriter will calculate, and this will show how much money is going to be left over each month after the borrower pays their bills. And lastly, significant income that we can see that is documented that the borrower receives, however, we're not using it as effective income. For example, let's say the borrower just started a second job 12 months ago, and we can see that income, however, we don't have a 2-year history to be able to use the income from that second job. That would be a compensating factor. As a side note, we cannot use the income from anyone else in the household who is not on our loan as a compensating factor. Loan officers, don't forget to include a loan officer cover letter highlighting the strengths of the file and outlining which compensating factors you're using for your DTI. If you're a loan officer who's used to your typical conventional 20% down, 800 credit score ASMR, yes, this is a little different, but it doesn't have to be scary. Manual underwrites for FHA have very straightforward guidelines that we just covered that will allow you to close these loans with ease. Thank you so much for watching my video, and if you haven't subscribed yet, hit that subscribe button and turn on notifications so that you never miss a video like this.